We're at a very important crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do. And then whichever way it breaks out, trade that trend.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of the week for another weekly market recap featuring my good friend, the fraternal portfolio manager, Lance Roberts. Lance, how you doing?
The older I get, the more paternal I feel.
Thanks. Although I said fraternal,
Oh,
for two
gotcha.
reasons. One, because I've just spent the week with my brothers. I had a rare week away from the computer. It's been wonderful. We
Nice.
get to end today's video actually a little bit early because I've got to take one of them to the airport. But also, Lance, because I think of you as a brother.
I appreciate that. Same,
Yeah,
same goes for me.
thanks. But I don't like my brothers, so
It's okay. I don't like
you
mine.
can understand why. Yeah.
I haven't spoken to my real brother in 25 years, so there you go.
Yeah. Well, there's probably a story there we'll get into at some point.
No, that story doesn't need to be told.
All right. Um, all right. Well, look, so folks, we're gonna keep today condensed and pretty on track. Um, Looking at the markets, Lance, I've been starting to hear in my mind the Talking Heads song "Road to Nowhere,"
Yep.
where the market's trading kind of as we speak, is where it was trading before Halloween
Yeah.
of last year, and we're just about in March now here in 2026. So it really has gone, pretty much nowhere in the past number of months. Um, so a couple questions for you, Lance. Last week, we talked about how the market could be sort of healing here, or positioning it, consolidating and positioning itself for a run higher. Curious to hear if you still think that way. And what we have seen certainly so far this year is capital rotation out of the hyperscalers and the software companies, into more value plays, right? It's been a growth to value transfer. When we talked last week, you were beginning to say, hey, like especially with some of these software companies, like the baby's getting tossed out with the bathwater, there may be a good opportunity to start building positions in these beaten down companies and wait for capital to then re-rotate back into growth from value. Do you still have those sort of same perspectives, or has anything changed in the past week?
No, nothing's changed. Timing is always going to be the hard part, right? So, trying to get these rotations, exactly perfect are going to be difficult. So if you're going to try to play, areas of the market that are under a lot of pressure, just be careful that you're going to have to maybe sit with them for a while, and it's going to kind of be dead money for a bit until the market actually starts to realize that a lot of these narratives that are out there that are kind of driving this current environment are not valid. And when you start looking and when the market starts looking back for where there's a margin of safety, they're going to start looking for companies that have really good valuations and a good moat and a good margin of safety. And a lot of those companies reside in that tech space right now that have been particularly beaten up.
Okay, so maybe we can, we'll do some of the charts in a bit. Maybe you can show us on the chart kind of where capital is still flowing right now and where it isn't. Um, but let me ask you this, and maybe we should just go to the TA and kind of get that over with today.
Okay.
Um, Technically, I'm doing this from memory here, but we had a break down below a couple of daily moving averages, and we were waiting to see if the markets could recover and bounce above them, or if they were going to start acting as resistance. I don't think we've broken back above them, correct?
No. Well, actually, we did. So this was a really interesting week overall. And I wrote about this in this weekend's newsletter that's coming up. It's called, is the market topping or not? Because there's certainly some indications that this market could be in a topping process. And so we want to certainly be aware of that. But if you look back at this week, we opened the week lower on Monday over these kind of AI concerns issues. And then the market rallied back over the next 3 days, and got up, we came right off the 100-day moving average, tested that support, came right off that support level that we've been doing now really ever since last April, broke above the 50 and the 20-day moving average. So that was actually looking pretty good. And then
Oh,
on Thursday and Friday, we reversed all that. We're back down to the 100-day moving average. So we've not gone anywhere this week. So, from a trading standpoint, it's been a bit frustrating if you're long an S&P index fund or whatever. But there's just been this continued kind of consolidation. And every time we rally back up to these resistance levels, we fail and come back down and test support. Now, the good news is that buyers keep stepping in right at the 100-day moving average. We get down there, buyers step in and start buying the market. So that's okay. We haven't broken. Now, if we break the 100-day moving average, which is this black line, then potentially we've got, kind of reversal down to maybe those November lows potentially, which would be around 65.50-ish, somewhere around there on the S&P. So, a 3 to 4% correction, that's completely normal for the market. Shouldn't be anything to be overly concerned about. But the question is that if we do get that kind of a sell-off, is it going to continue to be in the technology space, which has been under the most pressure, or do we see those stocks start to hold up better from a valuation standpoint, and we start to see these really overvalued stocks in staples, energy, industrials, materials, utilities? Do we see those start to sell off and money rotate back to safety in the other direction? Remember, this whole rotation we saw was that overvalued mega cap space into the value space that you and I talked about last October. We said, hey, watch out for this. This is why we're adding some value stocks to our portfolios. We're looking for this rotation. That rotation has now occurred, and now technology is actually cheaper on a forward valuation basis than staples, industrials, and energy, all three of those sectors. So you're overpaying now for the valuations in those kind of value sectors. They're no longer value anymore. And the growth sector has now become much more of a value sector than it was, 6 months ago.
Okay. I just got to ask you, because we're looking at this chart here. I'm guessing you sort of drew
Parabola.
that parabola there at the top. Yeah. Because you look at that and you think, oh, well, that clearly looks like the market's topping. And I'm sure you were doing that for whatever article you were writing, just asking that question.
Exactly.
Yeah, okay. So folks watching this or looking at this chart shouldn't read too much into that. It's really just sort of think of that as a question mark. What would you need to see, Lance, because it sounds like this could even break down to the November lows, and you wouldn't necessarily say it's a rollover. You might just say it's a shallow correction. What would you need to see to think that it was something bigger to the downside?
We need to take out those November lows. And by the way, those November lows are right about where the 200-day moving average is as well. So, there's certainly some concerning signals that are starting to show up. And let me back up here just a little bit. So the 20 days is about to cross below the 50 days. So that's not a great signal, right? So that's a bit on the bearish side. Certainly warrants some caution. And because of that, because of this kind of action right here, we reduced our exposure in our equity model a little bit this week. Nothing major, just a little bit. But last time we had that occur was back in kind of January 2025. The 20 crossed below the 50, then immediately reversed and went up into March. And then, of course, March was where we had the whole tariff, situation resolve itself. But so these kind of crossovers are important to pay attention to. Now, on the good side, we've got a momentum buy signal in place right now, and relative strength, the market isn't really that overbought. So from a technical basis, we've already this consolidation has kind of worked off a lot of that big overbought condition that we had back in, September, October last year from that huge run up from those April lows. We've worked off a lot of that situation. So, downside risk is becoming less. But again, 3 to 5% corrections are completely normal. And that's kind of what we laid out in that kind of South Park article, at the beginning of this year is like, expect a year of lower returns and more volatility. And so far, that's exactly what we're getting.
Yeah.
We've got a lot of volatility, a lot of rotation within sectors. Like I said, volatility's picked up here a bit. It's been a little bit more challenging. If you're an ETF indexer, it's been a little bit more challenging of a market this year. If you're more of a stock picker, it's been a little bit easier because you just kind of pick stocks in certain areas that are doing well. So from being a stock picker basis this year, it's actually been pretty decent. But if you're just kind of an index investor, it's been a little bit more challenging.
Okay. And we've talked about this when markets become more volatile, the passive strategy that everybody's been using for the past 15 plus years, it doesn't generally doesn't work nearly as well, and it's where an active management approach really tends to do a lot better, and that you can actually do well even if the market goes sideways, right? If you're catching the cycles within the process well.
Right, exactly.
Yeah.
You know,
Okay. No,
you
go
know,
ahead.
and right now the market's just holding up support. This kind of dotted black line right here is just kind of these bottoms that we've been running, and the market just has been. This is more of a consult. The article this weekend is just laying out the kind of the is this a topping process? Here's kind of what the technicals say. Could this just be a bullish process building up for the next like higher? I kind of go through that as well. So it's kind of a bull bear point counterpoint type argument. Because again, we could easily break out. If we get to new highs, this consolidation, we'll look back and go, yeah, it was a great consolidation. Should have been
Right.
buying the crap out of the market because this market's now ready to run. So we're at a very important kind of crossroads where the market needs to decide what it's going to do. Set all the narratives aside. The market just needs to decide what it wants to do, and then whichever way it breaks out, trade that trend.
Okay. And right now, do you have a gut feel or an informed feel, one way or the other? Are you leaning more towards a breakout versus a breakdown, or vice versa?
No, I don't. And that's the challenging part is if I had a gut feel. So we've been running so ever since the April low. Let me bring my chart back up here real quick, and let me just kind of talk you through this. So back here in the April low, on April the 7th, right here, we added a bunch of exposure to our portfolio, and we were underweight exposure in equities. We were about 50%, 52% equities during this decline. So we'd reduced our exposure during that whole tariff rumble. And then then at this bottom in April 7th, we had, if you go back and look, the sentiment gauges that we run and the allocation gauges that we run were at the lowest level since the financial crisis. The sentiment was so negative, positioning was so negative. It was just like the buying opportunity, and it was just so we actually overweighted our equities. Our target weight in our 60/40 allocation model, as an example, is 60% equities. We got down to about 52% going into the correction, and then coming out of that correction, we went to 65%. And we ran 65% for most of last year. So we were overweight equities, underweight fixed income and cash. We took that back this week. We're now back to just target weight equities because of this consolidation process. Now, it doesn't mean that I'm concerned about a breakdown now, but I'm starting to position myself that if this market begins to break down, I can more easily get underweight equities sooner than having to come back down through the cycle. So I'm kind of positioning potentially for this to be more of a risk off trade, but I'm not expecting a giant crash, but a 3 to 5% correction back to some of these previous lows would not be surprising at all. That could certainly happen. There's certainly some concerns out there from Iran to tariff policy to AI, et cetera. There's all these kind of things that are out there that are weighing on the markets. So if we get this correction, I don't expect it to be deep because the economic data is still very good. The earnings data is extremely strong. So whatever correction we get is going to be shallow and will be a buying opportunity, but I don't want to ride that down. I want to have some cash available to buy with if we do get a dip. If the market breaks out, then I'll go back to overweight equity and we'll just trade whatever next move as it comes up.
Okay, that makes total sense. So just to be super clear for folks, when you say
Mhm.
target weight equity, that's 60%, right? Because you run a
Right. Well,
60/40 portfolio.
right. So in the 60/40 model, it's 60%, and the 80/20, it's 80, and the 20/80, it's 20, right? So whatever the target weights of the models are, that's where we've gotten back to right now.
Okay. All right. All right. Well, folks, we'll be tracking this week to week from here with Lance, and when he can't be here with his partner Mike Leibowitz. So you'll get a strong sense in real time of where things
Mhm.
are headed. Especially, if we do get a breakout one way or the other, we'll then adjust accordingly.
Sure.
All right. So you mentioned a couple of uh, concerns that the market has right now. The day that we're talking, Friday,
Mhm.
there are kind of two dominant narratives in the headlines. One is that PPI came in
Mhm.
hotter than expected.
Yep.
U.S. producer prices came in at 0.5% month over month versus expectations of 0.3, and higher than the revised number of 0.4 month over month in December. They're up almost 3% for the year. So, a little bit higher than folks expected. This is being driven by services
Right.
mostly, which have been sort of disinflating of late. So this is a bit of a reversal in services. So all of a sudden the market's thinking, oh, okay, maybe inflation is going to be a little bit more of an issue than we thought. The other thing that's going on, which we'll talk more about in a second, is sort of renewed fears of the disruption that AI is going to bring to the corporate landscape. And the company that's got everybody's attention right now is Block, which is run by well, I'm blanking on his name, Lance, but he's the guy who founded Twitter, Jack Dorsey.
Jack Dorsey,
Um,
yeah.
but today, basically, Block announced that it's laying off half of its staff, or approximately half of its staff, because they're saying we just don't need them with AI.
Right.
That the AI models we're running are starting to do the work of salaried people. So
Right.
let's start first with the PPI. I know this is one data point, right now, so don't make too much of it. And I guess my question for you, Lance, is does it in any way alter your thinking that I think you and I have shared up to now that 2026 is more likely to be a year of disinflation than inflation?
So there was nothing really shocking in PPI today. It's not surprising that it ticked up a little bit. If you take a look at all the Fed manufacturing indexes, Chicago PMI, Philly Fed, regional Richmond Fed, Dallas Fed, they've all been upticking lately. So economic growth is coming back, and
Yeah.
we're starting to see a pickup in economic activity. Again, so setting aside GDP, as an example, GDP was 1.4% in the fourth quarter. And as we talked about, that was all due to the government shutdown. So that's going to come back pretty sharply in January and in the next quarter. So when we see first quarter, we're probably going to see a 3% GDP growth in the first quarter, something around there. But because you look underneath the surface, all these manufacturing indexes are coming back rather strongly. This is that reflation trade that we've been talking about here for a while, is that the hyperscalers, they're spending all the money on this Capex to build out these data centers. Well, that's going to translate into economic activity. And so we're starting to see that actually show up now in the data. So it's not surprising that PPI picked up here a little bit. Again, as you noted, it's mostly in services right now. Energy prices have come up a little bit, so that's feeding into it, but energy prices aren't running off to the moon right now by any stretch of the imagination. So, we're starting to see a little bit of a pickup there, but PPI is still running at, like I said, 2.9%-ish. And we run a composite between the CPI and the PPI. So if you take CPI and subtract out PPI, it kind of gives you an understanding of who's absorbing all the cost. And for the last year, the reason we haven't seen any inflation is because all the producers were having to absorb all the cost increases from tariffs, et cetera, and they weren't able to pass that on to consumers. Well, that's been recovering. And right now, that differential between CPI and PPI is about negative 0.8. So it's almost neutral, where it's almost an even balance. They're the consumers and producers are basically just trading off on prices right now. So it's very close to that. So we're starting to see this kind of repair within the system of things kind of going back to more normal levels. And this, we had big divergences coming out of the COVID pandemic, obviously, because we shut down the economy. And that's all starting to normalize. So now we're starting to get kind of more realistic numbers for where we are. But if you kind of look forward, this is, again, like you said, this is one number. And if you take a look at PCE and some of these other data points that really kind of lag inflation data a bit, inflation expectations are declining. The 10-year Treasury yield this morning is trading below 4% on that number. So if the bond market's looking at that number and going, this probably isn't going to be the case for very long. We're probably going to see some more disinflationary pressures later on this year. And so the bond market's already kind of starting to read off on that PPI report. So just from a standpoint of, if you're trying to make a case for inflation to come surging back, you might see a little bit of an uptick because of increased economic activity, but that should be expected.
All right, and Lance, to your point there, the people who care the most about inflation are bondholders, because inflation eats into your real returns.
Right.
And if they were concerned about rising inflation in the future, you would be increasing bond yields to be compensated for that. And as you said, we're kind of seeing the opposite. So right now, at least the bond market's not that worried about this post here. Um,
Well, that's also kind of one of the headlines I saw this morning, is that, PPI comes in hot, stagflation now the major fear. But stagflation, when you look at the definition of it, it's stagnant economic growth, high unemployment, and high inflation. CPI at even 3% is not high. So inflation at 3% is not high. I mean, 7, 9%, that was high inflation last year. But economic growth is not stagnant. I mean, again, we're running pretty strong rates of economic growth last year, with the exception of quarter four because of the shutdown. And if we start to run 3.5% economic growth this year because of all this capex spending, and unemployment's obviously not high right now, right? You take a look at the unemployment data; it's still very low. Um, it's hard to make that stagflation argument at the moment. This is more of an inflation caused by economic activity.
Well, and I think our point here is, you know, uh, it's a blip
Hmm.
so far. It will continue in the future. I don't know. We'll look at it here. But uh, there's a lot of reasons to consider or to believe that the headline CPI inflation measures are going to continue to disinflate for reasons that you just mentioned, and the
Yeah.
bond market seems to be in concurrence with that. Um, I did want to ask you about the PMI, the Chicago PMI numbers, which just came in today. And you've already kind of taken the conversation there already, but let me just share this chart. So you'll see here from this chart, Lance, that for the past 2 months, PMI has really rebounded. So you can see, basically since the middle of the pandemic, we've been in contraction mode here in the manufacturing space by these readings, right? Anything less than 50 is considered contraction, and we've kind of vaulted back up into expansion over the past two readings here. Will this continue? Who knows? But this goes back to the question that I've been asking you for, past several of these weekend chats is, the administration has been saying, hey, look, we've been doing an awful lot, since we got elected to sow the seeds for material economic expansion going forward, and it's starting to kick in here in 2026, and that's why Bessent has been saying, I think 5% GDP growth's in the cards, and Lutnick's been saying, well, I think it could be a lot more than that. Trump
Mhm.
obviously is putting a ridiculously much larger number on that. And so, I've been asking, well, what do you think? I mean, could this be a year where the GDP growth surprises to the upside? I think both you and I are definitely open to that. And you look at that
Sure.
PMI chart, and that's what you would expect to see if what the administration is telling us to expect is actually starting in process here. Now, we'll have to keep tracking it going forward, but I give that as sort of early validation that I don't want to say that the golden age is arriving, but the age of uh, boosted GDP, those are the early signs you would expect if we were indeed entering into that.
No, absolutely. And this is something that I actually had talked about on, I think Friday, maybe Wednesday, on our YouTube channel. But I was showing this chart. So this is CapEx expenditures by hyperscalers. You've all seen this chart before. This is not new. But here's 23, 24, 25, all in the dark blue. And then the light blue is expectations to come. So if you think about this for a moment, what we're seeing occur in the economy, you should have, this was very expected. And, because again, once I start spending money on CapEx, I'm spending that money to go do stuff, right? So we're talking about 500 data centers being built in Texas. North Carolina's building a crap load of them. Idaho's building a bunch of data centers. Well, that's putting people to work. That's buying, materials, cement, building roads, building out electrical plants, et cetera. So all that's feeding into the economy. So we should be seeing that translate into stronger economic growth. So here's two points on this. One, if we do get 4 or 5% economic growth, like Scott Bessent's suggesting, I don't know if we get there or not. There's a lot of other factors that kind of feed into things. We'll talk about the consumer here in a second. CapEx is 15% of GDP, right? So you can do a lot of CapEx, and its impact on GDP is not going to be all that significant because it's only 15%. But the point is, you should see an impact, and we're seeing that again. Chicago PMI, the New York Fed, the Richmond, the Dallas, all those Fed indexes are all turning up. We run a composite between ISM, the manufacturing and services indexes, and the manufacturing side of ISM has been negative for like 2 years. It turned positive this past reading. It's back into expansion territory. Services never got down there. So, we're seeing that translation of that spending into the economy. Now, you're going to get inflation a little bit of inflation, if you have 5% GDP growth, you're going to have 3.5, 3.7% inflation. It's just you can't have that kind of economic growth activity without a pickup in inflation because you're causing demand within the economy. But
Sorry to interrupt, but the
right,
reflation trade basically says, yeah, but it doesn't really matter that much, right? Because if we're growing faster than inflation, and
that's right.
importantly, wages are growing faster than inflation, then consumers are better off net net.
Absolutely. Now that you get the A plus for today's analysis.
Oh, good. Boy,
Now,
you
now
never give me good grades. That's
I know
excellent.
exactly. But now keep that now set that aside for just a second, and then let's talk about the other side of this, the consumer. Consumers, and this is really kind of today's article that I wrote as well.
Yeah.
It's on the website.
Can I make one point before you go there?
Sure.
Because I just
Yes.
want to comment on this chart here. So some people might be looking at this chart and saying, okay, Q1 of 2026 has the highest bar, but then the bars start falling off from there. So
That's right.
maybe the future isn't going to be as big as the past. I just want to point out, this is percent increase. Am I
Right.
correct here?
That is, yes, you're
These are
correct.
the growth rate, right? So the diminishing growth rate as you go into the future is just due to the law of large numbers, right?
That's correct.
And
And
so
but it is notable if I am if my spend rate, right, is slowing down, right, even on a percentage basis, that is going to feed into the economy. So looking at this chart, we should expect that this boom of economic activity we have is not going to be sustainable long term. Because again, let's just step back, forget this chart for a second. Let's just talk logic for a moment. Once I build all the data centers that I need, then what?
yeah,
Right?
totally different point. A good point. But let me just make my point, and then you can
Sure,
finish
sure,
your, which is, so you just pull the chart back up if you can.
sure. Yeah, absolutely.
But so I think like at the end of this year or at the beginning of 2027, it drops down from 86% in Q1 to, yeah, 47%
Mhm.
by Q4. Just remember that 40% is a 40% growth from the total number the quarter before, right? Which is going to
That's
be a
right.
lot bigger than it is right now. So it's still
Oh
an
no, this is not
awful.
quarter before. This is year over year. So not quarter before, year before.
Oh,
So
okay.
if I did 1 million last year, then I'm doing 1,000,005 this year.
Okay. All right. So it's a year over year growth.
Yeah.
Okay. You're right. I see year over year. All right. So then maybe it may diminish. My question here though was for a good while here, for the next couple of quarters,
Mhm.
at least, if not next couple of years, we're still going to be having positive year over year growth. And, look, 47% year over year growth from a
It
large
ain't
number
nothing.
is a lot, right? So all I'm saying
Exactly.
is there's still going to be an awful lot being spent,
Yes.
and that number is going to continue to grow throughout at least this 2 year projection. So don't look at this and thinking like, oh, the spigot's drying up and there's going to be no Capex spending. It's like, no, the growth rate may be slowing, but it's still going to be a ton of spending. So it's going
Yes.
to employ people, all that stuff.
But yeah, but correct. And then but at some point we will have built all we're going to build. Well, we will have built most of it, right? So there's this initial rush to go build all this stuff, but eventually that's going to slow down.
Yeah. And don't worry,
And
we're going to talk about this part when we get to AI and jobs displacement and all
sure,
that
sure,
stuff.
sure. And so once we get all this stuff kind of built initially, yes, we're going to continue to build new data centers, but that spin rate and the speed and the velocity is all going to slow down, and that's going to feed back into economic growth. So a lot of these trades that we're chasing today, as an example, when you're paying historically high valuations for energy stocks, historically high valuations for industrial stocks, you're really depending upon the spend rate for construction to be running almost inevitably into the future. And that's
Yeah.
just not going to be the case. And it's always interesting. Everybody's so concerned about technology. It's like, oh, tech's in a bubble, it's all going to blow up. But you can also make the case that a lot of these other sectors of the markets are starting to get into bubble territory as well from a historical basis. I mean, you're talking about industrials and staples trading at valuations we haven't seen since the dot-com crisis. So, it applies to all areas of the markets. And so the point is just simply to look ahead and say, where does this look like in the future? Which brings us to the consumer, which is 70% of GDP. Savings rates are dropping like a rock right now, 3.5% on consumer savings rates. The credit card kind of spending rate is still going up, but that kind of rate of change is starting to slow down, maybe suggesting consumers are starting to become a little bit more kind of tapped out. And given the weight of the consumer in the economy, to where I know you're going to go to, Adam, if we start having a big reduction in layoffs, et cetera, that's going to certainly impact the ability of the consumer to support the economy. So again, going back to percentages, yes, I'm spending a crap ton of money in Capex. That's 15% of GDP. The consumer is 70%. Who wins that battle?
Right. Right. Okay, good. This is opening the door for where I want to go with this. Just I want to note one thing you said, which is, I'm not saying this is the case, but if everybody was concerned we had a bubble in AI, and now you're saying, hey, we may have a bubble in value. Yeah, the hyperscalers and the growth traders, some of the froth has come off here, but I'm just saying there's the potential that there is a bubble in both. Right? And
Right.
if there are, to the warriors out there, that raises the idea that, hey, if I was worried about the AI bubble, maybe there's an even bigger bubble for me to worry about here. Again, folks,
Right.
I'm not saying that's the case, but it's just
No,
one
no, no.
potential outcome
Just
here.
pay attention to valuations. It's just valuations are important everywhere, not just in tech.
Right, right. And just to echo Lance Roberts, the fact that valuations are stretched is important signal, but it's not a good important. It's not a good timing signal,
Right.
right? This stuff could be elevated for a lot longer than you imagine.
Absolutely.
Let me ask one thing you mentioned earlier too. So you were talking about CPI and PPI and the difference
Mhm.
between the two, and that largely the producers have been eating the impact of the tariffs.
Yeah,
Um, I believe that to be true. I don't have the most recent data on this, but the last data I looked at was that corporate profit margins were still in record territory.
they are.
So, they've had the ability to eat the impact of the tariffs because they've been doing so well relatively. Are we seeing any change in that right now? Like, is there any
Well,
reason to think that the corporations would start trying to push any continued inflation onto the consumer yet, or can they still eat it?
it's kind of a tough question to answer today at this moment. I'll tell you why in just a second. Can you see this chart right here?
Yep. It's a little
Um, so,
small, but yeah.
okay, let me see if I can make it a little bit bigger here. Hold on for me. This is the blue and the red. This is my spreadsheet, so I apologize for the kind of the non-formal view
No,
of
it's
it.
cool. We get to see the sausage being made.
Yeah, if you really want it, here it is. So the black line is earnings. This is reported GAAP earnings year-over-year percentage rate of change, and the blue and the red is the differential. This is the spread between PPI and CPI. So when you'll notice that when earnings are booming the most, that is when it's the favor is tilted towards the consumer. When it's negative, that's when it's not the favor is not tilted towards producers, right? It's a disadvantage for producers. If it's blue, it's a disadvantage to consumers. Consumers are having to eat it. So that makes sense, right? Because if I'm able to pass, if when the consumer is having to eat the inflation, that obviously boosts my earnings and vice versa. So we've been seeing this recovery. You'll see this red line, this red valley here has been recovering ever since 2022. When we got through that 2022 kind of sell-off in the markets, earnings troughed, and then we began having to recover. And slowly but surely, we've started to transfer the price pressure from the producer back to the consumer. The reason I can't answer your profit margin yet is because profit margins are only posted quarterly.
Yep.
So as of right now, this is net profit margins versus the 10-year break-even inflation rates. And and as you can see, just looking at profit margins, they've been stagnant here for a while. But I think once we get this first quarter in, I think we're going to see that uptick to about 18%-ish, somewhere 18, 19%, be somewhere in that range. So I think we're going to see an uptick in profit margins because inflation rates have been, kind of the inflationary pressures have been pretty low. So that's been helping to boost profit margins for companies.
All right. Well, let me just ask this, and it's kind of a naive question, but like, if that's true, if what you think is going to happen is true, and profit margins go back up, how can they justify or otherwise get away with potentially passing additional tariff increases on the consumer when they're making so much profit on a historically comparative basis?
Well, if the world worked in a manner where we all did what was best for everybody else, then this would be a very different world that we lived in.
Hmm.
But the bottom line is simply this, is that if I may, so my bottle of water that I bought from Costco, right? Let's say I sell it for $1 normally, and my input costs come up. But this is a really hot selling item at Costco. I don't know if it is or not. I just
Yeah.
buy this there. Um, but let's say this is a really high demand product at Costco. And Costco says, well, my costs have gone up, so I'm gonna charge $1.25 for this now, and people keep buying it, then they're gonna sell it at $1.25. And if they sell out at $1.25, Costco's gonna go, well, I'll sell it for $1.50. And they're gonna find the point to where consumers rebel and say, I'm not gonna buy that product, I'm gonna go buy a different product that may be cheaper. But that's just business. That's just the way capitalism works. So, there's not a, what drives prices is the supply demand imbalance. And this is the case for everything. Stock prices, grocery prices, egg prices. If you have two, we had with the avian flu, we had chicken prices, egg prices go through the roof because we didn't have enough eggs. And people were willing to pay $8 a dozen for eggs. Now there's a huge supply of eggs, and and consumers are going, yeah, I'm not paying that anymore. So,
Yeah.
the price of eggs have come down. But that's just the way capitalism and
Well,
markets
that's
function. Yeah.
supply and demand in a
Yeah.
free capitalist market. And I'm looking at the time and realizing I got a lot more wood to chop, so I don't want to
Good.
get too distracted on this. But I'm going to say something that might sound a little like, oh my God, that's socialistic. And
Probably.
so you and I have ranted that we don't really have free unfettered capitalism, right? We have corporatism, crony capitalism, whatever you want to call it, right? And we have a lot of industries that are kind of more like run like cartels, right? Where they have a lot of pricing control. They've paid off regulators to get huge regulatory moats and stuff like that, right? So um, the so one could make the argument, hey, they have artificially high profit margins now, and they are sort of scalping the consumer. And of course, the long-term blowback could be not just consumers stop buying their stuff, but they actually complain enough to our elected officials that, they start going after companies for windfall profits or,
Which you definitely do not want to have happen. That's
uncompetitive
that's
practices.
a terrible outcome to do that. The better solution to solve the problem is stop buying iPhones, as an example. Just if y'all would just stop buying iPhones and start going to buy an Android or go buy a flip phone for a year or so, watch how cheap an iPhone will get.
Right, or
The
practice
consumer, the
frugality
consumer,
on lots of things. Yeah, I'm there
yeah, the
with you, and we
consumer
could we
has
could rant about this a lot,
yeah,
but
yeah. I'm just saying the consumer has total control over prices. It's just you've just got to be willing to sacrifice buying whatever fashionable trend item there is on the markets. I mean, there's no difference between an Apple and an Android phone, but you just pay a lot more for an Apple just because you want to buy the brand. There's no different. Look, I think Starbucks coffee sucks, but people buy Starbucks coffee because it's a culture, right? It's a thing. I can buy better coffee at the grocery store, but that's just me. But if we all stopped shopping at Starbucks, the price of Starbucks would come down dramatically.
yeah. So let me earmark this because what I want to dig into here is something happened in recent years where corporate profits went up to a new level,
Yep.
a new high plateau. Something is keeping them there. And
Hmm.
the question I want to dig into is sort of why and, you know, is this healthy? I personally gut feel don't think it is, but I'll be open-minded here. And what can be done about this, right?
Right.
Whether does consumers just have to band together and say, we're going to adopt a culture of tightening our belts a little bit and force these guys to bring things down? Or is there stuff going on? And look,
Sure.
I'm the last guy to say that like the government should be setting prices. And I'm not making that argument at all. But, is there something here? And I wonder if this is sort of where, the administration when it's saying, hey, we got to make sure Main Street gets a turn and whatnot, where there may be some things at times where they say, hey, look, if there isn't problems with tariffs, whatever, you guys are going to have to eat, you guys, the producers, are going to have to eat more of it while your profits margins are above a certain amount. It's interesting.
Yeah.
We don't have time to get into it,
Yeah.
but I
Yeah.
just want to put a pin in it because I think there's something there to really explore.
Sure. Yeah, we can do that. No problem.
Okay. Um, so let me just talk real quickly about Block to get your thoughts on this. So as I mentioned, their stock soared. It was up at least 16% as of this morning on the news that they're basically firing half of their workers here. Um, and Jack Dorsey is saying, hey, like this AI stuff's the real deal. I think you're going to see a lot of companies following our lead. In fact, we think a lot of them are late to realizing exactly how transformative these AI technologies are going to be for corporations. It's about enabling higher ROI in growth and free cash flow. they're saying, and economies at Goldman Sachs have estimated that AI was responsible for job losses amounting to a 5 to 10,000 hit to average monthly job growth to the industries that are most exposed to it in 2025. So they're already looking retroactively and saying, hey, a certain amount of job losses that happened last year were because of this trend, and it's probably going to continue going forward. So my question for you, Lance, is, we've been debating how much of a job killer AI is going to be. I think we both think it's probably going to be pretty substantial material, but we're now starting to really see companies like Block
Mhm.
fully embrace it. I mean, to the point where you're firing half your workforce in one fell swoop. It's kind of nuts
Yep,
to think about it. So, how big of a deal
it's
do
a big
you
deal.
see this? Is this a real signal that we're going to start seeing some real job shedding as we go into 2026?
Yeah, yes, and again, this was a chart that Warren Pies put out last week, showing the differential between AI exposed companies and AI non-exposed companies, and those companies are still adding jobs. Companies that are exposed to AI, those are the ones that are suffering the biggest job losses. So, and that's not surprising. We talked about this before, is that if you have a job that is very systematic. Every day you do the kind of the same job every day, right? You enter data into a computer that,
Right,
or
especially if
or
it's
some
software
sort.
based. Yeah.
Yeah, yeah. You're going to lose your job. There's just no way around it. That job is going to get replaced by AI, and that's just a function of time. Companies, right now though, you AI can't build a data center, right? So we're hiring a lot of construction people. We're hiring a lot of electricians. There's gonna be like 500,000 electricians that need to be hired over the next 3 years,
Right.
that type of stuff. So we're going to see a shift in the job market. And yes, there's going to be AI related employment destruction. And, for people at the bottom of the ladder, they're going to love this because the jobs are going to get cut are going to be a lot of the white collar jobs. It's like, all you rich people finally getting the axe. Well, we're going to see a lot of those jobs because, if you're in sales and marketing and that type of stuff, AI can do that job pretty quick. Look, my job is very exposed to AI. This is why we're developing Simplivisor AI now because it's that future of portfolio management is coming. It's just a function of time, so we need to get ahead of the curve. Um, you know, Honestly, Adam, your job's at risk. How hard would it be to create an artificial AI
Oh,
developed Adam Taggart and have him do interviews, right?
yeah. I don't know me specifically, but probably pretty easy. But there's a lot of competitors in this space already that
Yeah.
are AI generated.
Yeah, exactly. And that's what I'm saying is like, you can look at most jobs and go, yeah, AI can definitely impact that job. Now here's the point. I just did this interview with Forbes yesterday. They read my article on nihilism and they wanted to do a piece on it. And so we had a long discussion on that yesterday. And the reality is that we saw that you'll remember this, right? So back in the 90s, you and I saw a lot of jobs go away because of the internet and .com, right? There used to be receptionists. We don't have receptionists anymore. The fax machine changed a lot of things that were going on. FedEx changed a lot
Sure.
of things. So these
Travel
innovations,
agents, dead.
yes, right. So these innovations, they come along and they do impact the job market, but we also have to look back and go, yeah, but new jobs came out of that. Things that you and I aren't even thinking about today. There's going to be some job that comes out of AI that AI will breed. Again, I have no idea what it could be, but there will be new jobs that will be created, new opportunities. People are going to start, as Elon Musk was talking about. AI is going to allow people to start businesses like crazy, right? So if you've been working for somebody else forever, AI is going to allow you to start your own business very easily in a lot of different areas. So, we're going to see a lot of job creation as well as seeing a lot of kind of traditional jobs are going to go away, but new jobs are going to come along. So we'll see what happens. Now the question's going to be though, here's the question. If the let's just say we lose as many jobs as we make. Let's just say that. But the new jobs pay half as much as the old jobs. That's a problem economically,
Right.
right?
Or
Because
we,
we're 70% consumption driven.
right. And then the other thing too is even with your generous assumption, which my gut doesn't share, but that's
It's
for a
just an
different day.
example. Yeah.
Yeah. But even in your example, we gain as many as we lose. Huge question is okay, if we lose all the jobs today,
Mhm.
how long will it take to get those new jobs? right? Are people out
That's
of
right.
work for a month or are they out of work for 4 years, right?
That's
Like that's
right.
a huge question.
It is a huge question. And then, this is where this is where I think we're making a mistake politically. If I was President Trump, I would be starting to talk about spending money to build out training centers, trade schools, these type of things. Hey, we're going to start an initiative. We need 500,000 electricians. We're going to need plumbers. We're going to need construction workers to build all these data centers to support AI. We're going to fund an initiative to start trade schools. We want to get you out of the inner city into a trade school and into a good paying job. I would be focusing on that and doing those type of things, help people start retraining for an AI driven economy. Look, you're not stopping AI. AI is coming. It's here and it's coming. But we're not doing anything to help people start transition. Everybody's kind of just sitting here waiting to be axed by AI instead of getting ahead of the curve and start getting certifications in AI. One of the differences that's going to be made is, look, software companies aren't going away, but they're going to be adopting AI to a large degree. So on your resume, you better have some type of AI certification somewhere on your resume, because whatever job you're going to go into, they're going to be using AI in some shape, form, or fashion. So get ahead of the curve and start. There's online courses that you can take to get an AI certification. Just do something to get ahead of the curve before your job comes to risk.
Yeah, I saw a chart. I don't have it handy, folks, sorry, but I saw a chart recently and it was the American population divided into these tiny little squares.
Mhm.
And uh, there were three colors. There were people that just aren't using AI at all. There were people who are using a publicly available free AI service. And then there were the people who are actually paying to use the AI service, subscribing to get the better AI and presumably
Yep.
do some higher functioning work with it. And it was just a couple of squares that were in that category, not much more that were using it as a free service. And then, I don't know, 98+% of the rest of the country that's just not engaging with it
Yep.
yet. And basically the point of that whole chart is like, if the tsunami is coming, the vast majority are just totally unprepared for it, right?
Yeah.
So
Absolutely.
again, we don't have a ton of time to dig into this. The key thing I wanted to make is, you and I have ranted about the potential disruption of jobs from AI. I'm a little skeptical about how many jobs it's going to create going forward, especially when combined with robotics. I also am a bit skeptical about what you said earlier is there's going to be a big manufacturing boom in this country, probably for the next 5 to 10 years. But what after that,
Right.
right? And of course, by
Because
that time, the
it's
robots will have learned how to weld themselves too, right?
well, not only that though, but let's say that it takes 5,000 people to build a data center. These data centers are huge. They're like 10
Yep.
football fields, right? So let's say it takes 5,000 people all together to build a data center. But after it's built, you need 200 people to run it,
Right.
right? That's the downstream problem with construction and these type of companies that we're all chasing right now and overpaying for valuations on companies like Caterpillar and Deere and these other companies. I mean, they're great companies, nothing wrong with them, but the valuations are just extreme, and we're assuming that this pickup in revenue is infinite, and it's not.
Right. And again, to that displacement of like, okay, when we don't need most of you anymore. Like I agree with you. I think that AI is going to bring tremendous opportunity for those who, are proactive and entrepreneurial and want to create their own company. And it might be a one-person company that's just run by all the agents that you create, right?
Right?
Um, but being honest, I think that is a relatively small minority of the population that's going to go that way. And it's what happens with everybody else. And the reason why I'm bringing all this up here is just, I think what happened today with Block's announcement, it's a sign that, this not only is it game on, but this pace may be faster than almost everybody, even those that have been following this space, maybe have been predicting. So, if you're
Well,
trying to keep your head in the sand, you might not have a lot more time before you really have to pull your head out and start thinking.
yeah. Now, one thing too, just also remember that we've had a boomer 3, 4 years in the market, right? Things have been very good for
Yep.
corporations over the last 4 years. So we had a lot of over hiring too. So part of and I'm not saying that what Block did today was simply just getting rid of over hiring, but companies tend to, when boom times are really good, we tend to hire kind of over hire or hire a bunch of people that we start kind of duplicating jobs and things like that. So when things start to slow down or you have something like AI come along, the layoffs may seem a lot bigger than they are because they're getting rid of a lot of that
Well, they're
excess
not big, they're
overhead.
not bigger than they are. They're not maybe as bad as we think because
Yeah,
you're kind of
yeah,
getting at the
they're
deadwood, the less
exaggerating. Yeah,
productive stuff, right?
and
But
I'm
it
not.
doesn't mean it's sorry to
Yeah,
interrupt,
yeah,
but like there is, I think there is a lot of
yeah.
underperforming labor out there, or excess labor, and so even if it's just job shedding of the non-essential jobs, like that could be pretty material. I
Yes,
mean,
again.
just to your point about consumer spending, these are people that are losing their income and not necessarily going to get a replacement anytime fast.
Absolutely right. And so I just want to make sure that we all just approach things with a little bit of rationalization and not just to like, oh my God, everybody's just laying off everybody and the world's coming to an end. Look, I agree with you. I think the job losses are going to be large and the responses to those job losses are going to be key. So again, I think the government needs to get involved with, setting up trade schools, those type of things, at least providing some support for those. Companies need to provide training. I think a horrible idea. Elon Musk was talking about the fact we're gonna have to have UBI. I think if you want to destroy the economy, put everybody on UBI because you just
Our
remove
economy and our
purpose.
culture, right?
Well, that's what I mean, because you just remove purpose at that point. If you don't have purpose, then society gets really bad really quick. So, I think that's a horrible way to go. So I hope we make better decisions. We'll see.
We'll see. So the
Yeah.
reason I'm bringing all this up, and we'll move on to closing up here,
Yep.
but is I think the way I'm looking at it, I have a hard time seeing the near term, like the next couple of years, as we increasingly go in this pathway, as the prospects for the employer rising and the prospects for the working class net diminishing.
Yep.
So I think there's going to be new jobs, the data centers and all that stuff, right? Like there's going to be cohorts that are going to find new jobs, and that's all great. But I think that we're probably going to be losing more than we're creating, and the ability to then jump to something else really interesting that pays you as much as you were making or more, I think is going to be a challenge for people. So I just see this unfortunate period where if you're frustrated with the fact that companies already have record profits and all that type of stuff, and the consumer has not been getting their fair shake, I think it's probably going to continue for the foreseeable
Yeah.
future.
And look, this is thoughtful money. And so that's what we're here to talk about, right? So if you're worried about that happening to you,
Take those actions that
don't
you're
wait. Don't wait for it to happen to you. Start saving today. Look at your budget, cut back on your spending, put more into savings, put more into investments, invest prudently. Don't take a lot of risk so that capital, when something happens, is still there for you. But start building that safety net. So if something happens to you, you've got 6 months of an emergency fund or a year's worth of an emergency fund sitting in cash in the bank for you to live on, to get between jobs, to retrain yourself. And don't wait to get retrained later. Start today. Start learning AI. I just ditched ChatGPT and I moved over to Claude. Claude is freaking amazing as to what I am so impressed with Claude and what it does and how it operates. It's made my life so much easier just in the week I've been using it.
It's really interesting. I haven't used it recently. I kind of use Grok just because I'm on X a
Oh,
lot.
10 times better than Grok.
Really? Okay.
No,
All
yeah,
right,
way
well, I'll go
better.
check it out. So I totally agree, and folks, both on the financial side of things, so that if you know bad news happens to you, you've got the best cushioning for it. But also to the future of Lance's point about like start skilling up, start trying and not just as a defensive measure, but to Lance's point, you might find ways to say, wow, like I could really use AI to either make myself even more essential at work, or maybe detach from my employer and go off on my own now that I can do all this stuff that I wouldn't have been able to do before. So there's a lot of opportunity
Or,
there.
or here, learn to use AI to displace the other guy's job that you work with and secure your own.
Yeah.
So
Yeah, they say your job's going to get replaced more likely not by AI, but someone who knows how to use it. Identify the people at your company you don't like and figure
be
out how
that
to
guy.
use AI to
It's
get
like,
rid of
hey,
them.
boss, look what I can do. You don't need Jim anymore.
Exactly. All right. Just want to get your temperature on one quick thing, and then we'll get to your trades and start wrapping up. Um, we are continuing to see concerns mount about the private credit space.
Yes.
And I think this happened by last week. I think we talked about Blue Owl and it freezing redemptions on one of its business development funds. And
Sure.
that kind of, that definitely raised some eyebrows. And again, not in and of itself a sign of crisis, perhaps not even for Blue Owl per se, but certainly makes the investing world a little bit more nervous about how bad some of these private credit loans may have been because we don't have any visibility into this industry.
That's right.
Today, we just got word that a firm called Market Financial Solutions over in Europe and England, I think,
Okay. Yeah.
basically declared bankruptcy. And shares of a number of big banks there, like Barclays, are getting hit because they've got some exposure to that. But basically, this is sort of like another tricolor, another first brand. It's just making people think, you know what, maybe Jamie Dimon was right. You see one cockroach, that probably means there are more.
Sure.
And how I know we don't have a ton of visibility and data here, Lance, but
Mhm.
from your perspective, uh, how worried, if at all, are you of a market moving event happening in the future if indeed we start seeing more and more casualties of private credit here?
Well, so first I'll understand I don't have exposure to private credit. We don't do that as a firm because of specifically a lack of liquidity, transparency, and opportunity, right? So
Right. But you
we
have
don't.
secondary exposure where if there's like it's not going to be a Lehman moment per se of scale, but if the market freaks out because all of a sudden it's
Well,
about, yeah.
that's what I was getting to. So we don't have any private credit exposure directly. So what we pay attention to is how is it affecting spreads in the liquid markets that we are in. So predominantly we're treasury focused. We do have corporates in our bond portfolios. So we're watching those credit spreads very closely, and we've seen those uptick here just a little bit lately. Not anything of major stress right now, so not overly concerned. MFS is certainly a deal, right? It's 2 billion. It's about $2 billion, so it's not nothing. But in the size of the private credit market, it's a very small fish.
Yeah.
So again, whenever we hear about this stuff, we immediately, and look, my nature is too. I immediately go back to the financial crisis and go, "Oh, is this the next subprime crisis?" And we all remember what happened with Lehman Brothers and all that.
Hmm.
I don't think we're there just yet, but I do think you have to pay attention to this. You and I have been talking about this for a long time, is that, the stuff with this buy now, pay later nonsense, this private credit lending, whenever you have so much money chasing so few assets, you're going to get a lot of bad deals.
It
And
always ends poorly.
yeah, and it always ends badly. And so you get these bad deals because these managers have to place these funds. So this is why it's so important as an investor that you understand what you're investing in. Just because somebody comes and pitches you a private credit fund or private equity fund, ask yourself, why am I so lucky to be getting this? If why are they coming? Why is your advisor coming to you with this when Sequoia and these other big hedge funds and VCs will buy this stuff right off the cuff, and they're in this stuff already. So you're at the bottom of the list. So why are you so lucky to get this really outstanding opportunity? And that's where you have to be really careful, because that's how you wind up in these funds that have like an MFS or a tricolor in them, because they're trying to boost returns and they're chasing poor quality deals to get there to capture money. And again, these people are going to walk away fine. They made their money. It's the investors that take the hit.
Yeah. Well, okay, let me ask you this because I think I'm
Sure.
going to ask you this in the future going forward on this.
Uh-huh.
In terms of your worry level of private credit and its a potential to metastasize to just impact the general markets and make your life difficult as a guy who's
Mhm.
managing publicly traded investments,
Yep.
where is it right now? A scale of 1 to 10, 10 being hair on fire.
3.
3. Okay, great. And
Again, it ain't nothing. If you would ask me 4 months ago, I'd say 1, right?
okay, well, and that's why I wanted to get this on record because I think I'm going to ask you this again and we'll see if it goes up or down from
Yeah,
here. Yeah.
yeah. Like I said,
Okay.
it ain't nothing. We're definitely paying attention to it, but there's nothing here to be. If you're in highly liquid markets, treasuries, triple B corporate bonds are better. You don't have to worry right now.
Okay. All right. So trades. I think you mentioned you lightened up your equity
You
exposure a
did.
little bit. Any other
So
specific trades?
yeah, yeah. So we're doing a couple of shifts. So this week we just kind of reduced some exposure very slightly. We didn't sell outright anything to any great degree. We trimmed back on JP Morgan, we trimmed back on BlackRock just a little bit. We trimmed back on Berkshire Hathaway just a little bit, just to bring our overall exposure down to 60% in the portfolio. So again, we're back to target weight. So in our 60/40 model, as an example, we want to be at 60% weight. We were overweight equities for most of last year. So we're just bringing that back to target weights right now. That gives us the next opportunity if this market does start to deteriorate some, that we're going to see, we can easily reduce that exposure. Now, coming up on Monday, we're going to be starting to dig in a little bit, and we're going to be trimming off. So back in October, we added a couple of value companies, Altria, Verizon. Those have had huge runs. So we're going to be selling Altria and Visa and taking those out of the portfolio because we have some concerns on the consumer side. So we're a little bit worried about Visa. So taking Visa out of the portfolio. We've held it for a long time, but we're going to take it out for now. And we're going to add some money. We're going to use that money. We're going to keep our equity weighting the same, but we're going to add to Microsoft and start, buying a starter position, and like ServiceNow and Salesforce, and start
Okay.
kind of digging into some of these really beaten up software stocks because
Okay. Which is
valuations
what
are
we talked
just
about last
compellingly,
week.
yeah, valuations are just so compellingly cheap here.
Okay. And cash flows are still really good and all that
Yeah,
stuff.
yeah.
So,
And again, we're buying starter positions. I hope these stocks can even go lower, and then I can add to them.
yeah, got it. And
So,
so just to be super clear, you are now putting into practice what you flagged for us last week that you would probably do.
yeah,
Yeah.
exactly.
Okay. Awesome.
And we may be right, we may be wrong. We'll see. But that's why we take small positions.
Yeah.
And if we're wrong, it doesn't hurt us. And this is why you don't go buy big positions and stuff right up front. Just wade your way into it. Make sure that your trade's going to be right, and then you can always build on it if it goes up.
Okay. Yeah, that's brilliant. You may be right, you may be wrong. I think you can say that about every single investing decision you make.
Every trade is a binary bet. You're either right or wrong.
I mean, I guess you can be really right or really wrong, but yeah.
Correct.
Okay. Well, all right. Let's start wrapping it up here, Lance. We don't have time to do a full rant. I just want to give a quick nod.
Sure.
And I was certainly obviously teasing at the beginning when I said I hate my brothers or don't like my brothers. So had a great week with them here. It's really been fun. Got to go skiing for the first time in, God, 15 plus years or so. And it's great doing it out here in the West, especially when you grew up skiing in New England, which we did, which is basically learning to ski on ice.
Right.
Out here, it's just
It's actual snow.
the locals kept talking about it had rained the day before, and the locals kept talking about like, oh my God, the conditions are so terrible. And we're like, are you kidding me? Like this is this is like 10 times better than what we've ever had. So, anyways, super fun, and I just want to say that it'd been a long time since I'd taken some time away from the computer, and it was a really good reminder of kind of the why. I'm doing everything that I'm doing in terms of, work focus and all that stuff. And I just want to, emphasize that so that hopefully folks who are watching here will make some time in their life to do something similar and really remind themselves of, okay, if I'm working really hard to invest, or if I'm working really hard to grow my income or whatever, don't forget to take some time along the way to keep your eye on the prize and say, okay, look, why am I doing all this? And also like, let me enjoy a little bit of it along the way, because tomorrow's not guaranteed, right? We don't know if, that bus might have our number on it tomorrow, right? And we want to make sure that if our life flashes before our eyes, we said, okay, I got enough of the living I meant to do out of it all, right? And look, for me, you hear me talk on this channel about, money, it's important, but it's a means, it's not the end. The end, what really defines a rich life is quality relationships, meaning, and good health. And I just spent 3 days basically having a ton of fun, with family and friends. And a lot of it was really physically active, right? And so it was all three things, right? It was finding meaning in my quality relationships, doing things that I could do because I've been investing in my health. Can't recommend it enough for folks. The only thing I'll say at the end here too is my brothers and I, we do this annually. And it's a great time for all the reasons I just mentioned. But one of the things that we have started a tradition of doing is we spend some time kind of talking about, okay, for each one of us, what's a big goal of yours for the year ahead? And, we kind of get each other to kind of articulate it and put it out there. And then over the coming year, we check in and we try to keep each other accountable for, hitting those goals. And, if we're having trouble or is there setbacks or whatever, we can, talk it through with each other. And it's really become something I think has been really sort of like a force accelerator in our lives. So, Again, you don't necessarily have to adopt that with your own family or your own, inner circle, but we found it to be really useful. So anyways, Lance, I'm gonna wrap up here in just a minute because, like I said, I took one brother to the airport before we recorded. I got to take the other one now. But you're actually happy that we're ending a little bit early too, because you, I think, are going out to spend some quality time with one of your children.
Absolutely. Yeah. We're gonna as soon as we hang up here, I'm on the road heading up to Austin to spend the weekend with actually both my daughters. One's at Baylor and one's in Austin. So we're gonna split the time up there and spend some days with each of them. So yeah, looking forward to it.
All right, great. Well, so folks, if you watch this channel to become a smarter investor, please take what we're talking about here as your nudge from the universe to invest in the things that truly matter to you. All right. Well, look, in wrapping up here, folks, if you think one of the ways to invest your time in the ways that will truly pay the best dividends for you is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like to get some help from a professional financial advisor based on any of the things that Lance and I have talked about here, or if the future unfolds the way that Lance and I have been batting back and forth here, I highly recommend that you get that from a financial advisor who at least takes into account all the macro issues that Lance and I have been talking about here. If you don't have one in your life who's already doing that, or would like to get a second opinion from one who does meet those criteria, then consider talking to one of the firms that Thoughtful Money endorses. These are the firms you see with me on this channel week after week. Maybe you'd like to talk to Lance and his team there at RIA. To do that, just fill out the short form at thoughtfulmoney.com and the firms will be in touch with you right away. Lastly, it just hit me, picking my head up after this week, that we only have 3 weeks left before Thoughtful Money's spring conference. So if you haven't bought your ticket yet, run, do not walk, to buy it at thoughtfulmoney.com/conference because we're still offering the lowest early bird pricing, but that's only going to last for the next week, and then the price goes up. So I want to make sure everybody gets that lowest price. And if you are a premium subscriber to our Substack, look in your email inbox for the code I've sent you. You can use that to get an additional $50 off of that lowest early bird price. It's a phenomenal faculty. Real quick, doing this just off the top of my head again, Lacey Hunt keynoting it like usual with his graduate level series of charts. We'll have first timers Ed Dowd, Michael Oliver, and everybody's really interested to get his forecasts for the precious metals. We're going to have famous journalist Matt Taibbi piping in. We're going to have Judy Shelton. We're going to have Danielle DiMartino Booth. We're going to have Luke Roman. We're going to have Brent Johnson. We're going to have Stephanie Pomboy. We're going to have Grant Williams. We're going to have Rick Rule. We're going to have Melody Wright. We're going to have David Hay. We're going to have Michael Howell. We're going to have Darius Dale. We're going to have Andy Scheckman. There's probably one or two that I'm forgetting, but it is just an unbelievable lineup, and that's all coming at you on Saturday, March 21st. That's when the conference is. And if you can't watch live, don't worry, because everybody who buys a ticket will be sent the replay videos within just a couple hours of the event ending. So it's going to be great. But don't forget, if you haven't bought your ticket yet, go now to thoughtfulmoney.com/conference. All right, Lance, as usual, my friend, I'll give you the last word here.
That's it. Have a great time with your brother, and I'll see you next week.
All right. Thanks so much, buddy. Have a great time with your daughters. Everybody else, thanks so much for watching.
We've got gold at 34.82, the spot price. It's up 35 bucks. So it looks like the breakout that we saw last week is being confirmed. You never know in the short term what could happen, but you need to hold on because this is the end game for fiat currencies, in my opinion. I don't know how long it's going to take. It could be months. It could be half a year or a year or two, but it's going to get very turbulent, in my opinion. So yes, gold and silver continue to trade really well, and what's happening is fiat currencies are dropping really. That's what's going on, and we got spot silver actually breaking through 40. Not that 40 was a key resistance, it was more of 39.50, but we are at 40.56 this morning, up 2%.
Gold surged to about $3,482, its highest in over 4 months, on Fed rate cut bets and a weaker dollar, with futures touching $3,500. Silver topped $40 for the first time since 2011, supported by tight supply and easing expectations. Analysts point to strong central bank buying, monetary policy shifts, and geopolitical risks as key drivers. HSBC projects silver to average $35 per ounce in 2025 despite dips, warning of a major supply deficit. Many see silver entering a potential supercycle, fueled by industrial demand, shrinking inventories, and its growing role as a monetary asset. While short-term moves are uncertain, the speaker, Mario Ineco, believes this marks the endgame for fiat currencies, which could unravel in months or a few years, bringing turbulence. He explains that gold climbed to a more than 4-month high, reaching approximately $3,486.86, buoyed by increasing expectations of a U.S. Federal Reserve rate cut and a softer U.S. dollar. Dovish commentary from Fed officials and legal setbacks for U.S. tariffs further weakened the greenback, propelling gold higher. U.S. gold futures also moved up, touching $3,554.60. Silver broke above $40 per ounce for the first time since 2011, rising 2.2% to about $40.56. Expectations of imminent rate cuts remain high, with the CME FedWatch tool indicating an 87% probability of a 25 basis point cut. This outlook boosts demand for non-yielding assets like gold and silver. To ensure you stay informed, please subscribe and turn on the notification bell before we start. Please leave your ideas in the comments section, we'd love to hear them. If you're enjoying the video, don't forget to like it.
This is the end game for fiat currencies, in my opinion. I don't know how long it's going to take. It could be months, it could be half a year or a year or two, but it's going to get very turbulent, in my opinion. So yes, gold and silver continue to trade really well. And what's happening is fiat currencies are dropping, really. That's what's going on. And we got spot silver actually breaking through 40. Not that 40 was a key resistance, it was more 39.50, but we are at 40.56 this morning, up 2%. Gold is up 1%. The Dow, S&P, and NASDAQ futures, they're down very slightly, so it's fairly quiet, not surprisingly. I've noticed, though, that the 10-year JGB yield, that's made a new high. It's the highest level since 2008. We're at 164. And I was just reading about a 2 trillion euro Dutch pension headache is coming for European bonds. So the Dutch pension fund managers, they're going to divest hundreds of billions of euros out of the longer end of the bond market, bonds like 10 and 30 years. And we know that in Germany, US, UK, and Japan, these yields are going through the roof. Yes, they're still under control, but what are government bonds? Well, they're just fiat currencies that are due for their loans in fiat currencies that are due in a certain amount of time. And as the system implodes, the fiat currency system implodes, so will the bond market. Yes, the central banking emperors might conjure up some trillions of dollars to buy those bonds, to monetize them. But all that will do is it will be more gasoline. It will throw more gasoline into the fire. It will just accelerate the demise of fiat currencies. Gold is the ultimate form of international payment. Well, we're seeing that, aren't we? Why are BRICS loading up on so much gold? Well, because the dollar system is going the way of the dodo bird, the dollar payment system, for that matter. And we saw over the weekend that President Trump was able to help BRICS. How did he do that? Well, the relationship between the US and India went down the drain. So now India and China are new buddies. They're part of BRICS, but it was always a little difficult relationship. So that's going to accelerate things even more in terms of countries loading up on gold and using the dollar less and less. Second part is gold is a barometer of fear and confidence, not inflation. Well, that's true as well. There's a lot of fear right now, and the confidence in the system is buckling, I would say. Gold is a measure of geopolitical power. Well, yeah. He who has the gold makes the rules, right? It looks like that's shifting, well, in relative terms, a lot more away from the United States to the BRICS. Am I for the BRICS? No, I'm just trying to tell you what's going on so that you can protect yourself, hopefully financially. This is a really good one too here, because we're seeing this and we're talking about this, right? Gold is a measure of government debt and the ability, willingness to repay such debt. Well, there you go. One of the reasons gold is going up now is because bond investors and Dutch pension fund managers realize that the payment they're going to get in 5, 10, 20, 30 years, it's not going to be with the same, well, it is the same currency, but this currency will have not the same purchasing power as it has now.
Mario points out that gold exposes falsely stated wealth by showing the gap between inflated asset values and real purchasing power. While deflationists expect a collapse in fiat terms, central banks can always print more money, creating the illusion of rising values. In reality, this erodes wealth for the majority, especially the bottom 90%, who lack significant assets and must bear the burden of falling living standards. Overstated expectations, whether in stock markets, social guarantees, or government spending, ultimately translate into higher costs for ordinary people. Much of the supposed wealth tied to real estate, equities, or pensions is based on debt and speculation rather than lasting value. As inflation outpaces wages, citizens are left paying more for essentials while being saddled with government debt from decades of mismanagement. Gold and silver serve as reminders of what real wealth is, revealing the truth behind currency devaluation and political promises. In the end, the public absorbs the cost of financial excess through reduced purchasing power and rising living expenses. Now let's move back to the interview.
Gold is a revealer of falsely stated wealth. So there you go. And I think that's where the deflationists get it wrong, because they expect to see a deflationary collapse in fiat currency terms. But the problem is that the central banks and the governments can always ramp up the printing press and make sure that those values go up. But in real terms, of course, as I said earlier, we're having a deflation. So let's go through gold is a revealer of falsely stated wealth. Gold is a revealer of falsely stated wealth. Let's get to it. When wealth is overstated and expectations for future wealth are unrealistic, fiat currencies depreciate. Well, what comes to mind when I read this is the fact that stock market capitalization as a percentage of GDP, which is a measure Warren Buffett likes, it's at all-time highs, like 210%. Anyway, that depreciation is borne by the citizenry. Yeah, the bottom 90% who don't have many assets, who are forced to lower their living standards to compensate for both personal economic mismanagement as well as the mismanagement of the affairs of state. Well, we know all about that, don't we? Financial and military overextension has a social corollary in overpromised Social Security, Medicare, overstated real estate, equities, affluence. as expense runs out of control, well, that's deficit spending, guarantees to the citizenry also explode as politicians seek to retain the privilege of office. Yeah, inflate or die, right? A big, beautiful bill. But the promises of wealth are false. The belief that ownership of real estate is a ticket to fortunes is hollowed out for what it is, a myth. And I would add, though, that having real estate over the long term, over generations, is a good way to store wealth. I think what they're talking about here is rampant speculation and borrowing to try to make money through real estate. Wealth that was taken for granted suddenly appears ephemeral. And I think that's what gold and silver are warning us. And it's also warning us that the central bankers and governments, they're not going to allow for the deflation in fiat currency because they're fighting for survival. So what gold and silver are going to do, they're going to reveal what real wealth is. The amount of currency which one bought certain things no longer does. But wages have not risen along with prices. Yeah, we know all about that too. Instead of wealth, citizens get saddled with a big chunk of government debt, i.e. debt created by mismanagement. The result is everyone pays for more for food, fuel, and other basic necessities. Government passes on the mismanagement of economic affairs to its citizenry by devaluation.
Gold and silver are acting as both safe havens and truth tellers in a fragile financial system. They reveal the weakness of fiat currencies, the unsustainability of debt-driven promises, and the erosion of real wealth for ordinary citizens. As central banks and governments struggle to maintain control, precious metals continue to highlight the widening gap between inflated paper assets and lasting value. Do you think more people will turn to gold and silver as trust in fiat weakens? How might rising demand for gold by nations like those in BRICS reshape the global financial order? Kindly leave your opinions in the comments section below. We would be delighted to hear them. Please remember to subscribe for more videos and give this one a thumbs up if you thought it was helpful. We appreciate you going on this journey with us.
China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and so right now this weekend, in fact, at the SCO meeting, the Shanghai group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia. Now they're the best friends after this meeting this weekend, and we always try to prevent them from putting an alliance together. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the U.S. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all.
At the 2025 SCO summit, India's Prime Minister Modi met with Xi Jinping and Vladimir Putin, signaling warmer relations. China, Russia, and India strengthened ties in response to U.S. tariffs and Western pressure, presenting the SCO as a rising economic bloc independent of Western institutions. Together, these nations represent 36% of the world's population, giving their partnership significant economic weight. With China secretly stockpiling gold and reducing reliance on the dollar, this alliance highlights a global power shift and exposes U.S. vulnerabilities in trade and finance. A 49-year veteran market expert, Bert Doman, recalls that since 2007, market manipulation has become much easier due to the removal of the Uptick rule, which had been in place since 1933 to prevent short selling abuse. Its removal opened the door for high-frequency and algorithmic traders to heavily manipulate markets. Many believe the SEC protects investors, but in reality it often protects insiders who benefit from such moves. This makes rallies risky, as they can be engineered, and safer bets like gold and silver have offered better returns during uncertain times. Looking at history, gold peaked at $800 in 1980 before entering a 20-year bear market, just as cycle studies had predicted, Bert Doman says. The bottom came exactly in 2000, aligning perfectly with long-term trends. Analysts had already forecasted back in 1980 that after this cycle, gold would begin a powerful secular bull market. Unlike shorter cyclical swings, a secular trend is long-term, and the current rise in gold is part of that ongoing secular bull phase. As we play snippets from the video, kindly click the like button, subscribe to our channel, and enable the notification bell to receive fast alerts whenever we post a new video. I appreciate your support. Have fun watching the video.
No, with the manipulation today, it's easy to be wrong. For 48 years, we basically called most market tops within a day or two. Okay, and that is using advanced technical analysis. It's become tougher since 2007. In 2007, they made it possible for the high-frequency trading and the algo traders to sell short without waiting for an uptick. We had the Uptick rule in place since 1933. It was Joe Kennedy, who was a big manipulator in the 1929 crash. He and his guys crashed the market in 1929. And then they made him head of the SEC. And he said, well, if we would have had an Uptick rule in place, we could not have manipulated the market downward. That means that if you put an order in to sell short, the order before that had to be on an uptick, a higher price, even if it's only at 1/8. And so that uptick rule was in place in 1933. And in 2007, they did away with it quietly. And we read it and said, oh, something is up. There's going to be a crash next year. And they want to make a big money out of that. And of course, we had the crash in 2008. So this was all manipulated. People have no idea. They think the SEC is there to protect them. No, the SEC is there to protect their friends. So a lot of money is being made with these manipulations. And so the up move in early April in the stock market, we said that it's going to be a bear market rally, but we'll probably have a couple of the indices making new highs by a small amount. But we don't want to play this. This is too dangerous because it doesn't necessarily have to happen that they will go as far as a few indices making new highs. So we sat that one out. Yes, we could have made a lot of money in that rally, but we had gold and silver and they made a lot of money for us. And then you asked about gold before. In 1980, gold had hit $800 an ounce. Okay, so we were along for the whole ride from 1977 onward. 77 is when I started my business, and so we're along for the ride. But then we got a sell signal on our indicators. We said, okay, time to sell, take profits. It's been fun. And then we did a cycle study on gold going back 400 years. So that was about 200 years in the US and 200 years we had to go to the data from Britain. And so we said, okay, this is going to be a 20-year bear market in gold. People thought that was crazy because everybody was still waiting for $3,000 gold at that time. But it happened. When was the bottom of that bear market? Year 2000, exactly 20 years after 1980. And it was amazing to us even because usually cycles, they move a little bit to the left or to the right, they're off by a few years and so on. But the bottom was in the year 2000. And, people want to know what the second part of the cycle study said is how far the next up move would be. So far, it's correct. Okay. So we said in 1980 how high this market would rise, the current bull market. It's a secular bull market. You always have to differentiate between a cyclical a bull and bear market and a secular. Secular is very long term.
Bert Doman point out that in the first phase of a market crash, investors facing margin calls sell whatever they can, including gold and silver, causing their prices to drop temporarily. But once that urgent selling is over, gold and silver rebound strongly as people seek safety while central banks print more money, eroding its value. That's when these metals shine as the only true protection of wealth. At the same time, India's warming ties with China and Russia at the SCO summit mark a shift toward a multipolar world, as the three nations, representing over a third of the global population, find common ground against Western dominance. Analysts warn that U.S. tariffs, especially on India, may be backfiring by driving these countries closer together. If they retaliate with tariffs or reduce trade, U.S. supply chains and retail sectors could face major disruptions, underscoring America's vulnerability in this shifting global balance. Now, let's recall the interview.
See, in the first part of a bear market, when the markets just tumble, and everybody has to scramble because they're getting margin calls. So they sell what they can't sell. And gold and silver, of course, it does have bids, and then they will sell that too. And in the first phase of a decline like that, gold and silver will be declined because it's being used as a source of cash. To meet margin calls. But then comes the second phase, and that is when all that is, urgent selling is out of the way, and that is when you really want to buy gold and silver. That second phase, because then everybody goes to safety. And gold and silver is considered the only safe thing, because the central banks then will step on the accelerator, manufacture as much money as they can, as they did in the year 2020, 2021. And that means that your money is worth less. The purchasing power of your money declines, and the only safety for that is gold, silver. They will go up. So gold and silver, gold has been an island of safety for thousands of years. It's not going to change. I think they know what's going to happen, what is inevitable. China has bought much more gold than the official transactions tell you. They're not reporting all of their gold buying, and so right now this weekend, in fact, at the SCO meeting, the Shanghai group, we had basically unification, which is incredible and very dangerous for the U.S. But India and China and Russia, now they're the best friends after this meeting this weekend. And we always try to prevent them from putting an alliance together. Now they are the best friends. Now this is together. These three countries have 36% of the world's population. That is a big amount. 36%. Do you know what the U.S. is? U.S. is 4.1% of the world's population, and this is where Mr. Trump is so wrong. He thinks that everybody needs the U.S. consumer. Okay, he's wrong. What would happen right now, for example, if these three nations having 36% of the world's population say, we don't need to trade with the U.S. If they want to raise our tariffs to 25 or 50%, we don't have to trade with them at all. We don't need their consumers. We've got enough consumers outside of the United States. And in fact, we don't even have to do anything more. We don't even have to supply them with our stuff. We're just not going to even sell to the United States. Can you imagine if these three nations suddenly decide not to sell their stuff to the U.S.? The shelves at Costco and Walmart, etc., Target, they're going to be bare. Because you take a look at all the merchandise you see on those shelves, turn them upside down and see where they're made. They're made in these three countries, most of them. So I think we are much more vulnerable to them boycotting the US than us boycotting them.
Both Bert Dohman's market insights and the geopolitical shifts seen at the 2025 SCO summit point to a world entering a new phase of financial and strategic realignment. As gold and silver continue to prove their long-term resilience, the strengthening alliance between China, Russia, and India adds another layer of pressure on U.S. dominance. These converging trends suggest that investors and policymakers alike must prepare for an era of heightened uncertainty and rapid change. Could the growing China, Russia, India alliance accelerate the decline of U.S. financial influence? Will gold and silver remain the most reliable safe havens as global markets face manipulation and geopolitical upheaval? If you like the analysis, then share your thoughts in the comments below. We'd love to hear from you. If you found this helpful video, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75. While the long-term targets of $20,000 for gold and $500 for silver remain highly speculative, current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982. With the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end's going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982. And the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, wow. 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, oh, you've already pushed it out again. No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions in derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough.
Sure.
We didn't go through a bear market. So that's what's unusual, and I think that's where people are going to probably get it wrong. Is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run, and I'll be at that point contrary and saying no, this is the top. We're close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative, and it comes. My reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt. As I keep quoting, 330 trillion in global debt, and I realize a lot of it's sovereign, but 330 trillion in global debt, and quadrillions in notional value of derivatives. Never been here before. Never. And derivatives are leverage on markets. Debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of Ukraine. But I stayed with it at 130 and said, we're going back to 85. And then once we broke 100, I said, we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. It could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand. And we've rationalized down supply, the mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand, because of the money print, can happen within 1, 2, 3 years, whereas having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, How might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.